Mark McDonald, thank you very much for your time. From Wizard Home Loans to the Yellow Brick Road, businessman Mark Bouris has been a financial disruptor and innovator. He's a loan broker who's riding the wave of Sydney's housing boom, where 60% of lending is to investors. And official figures out today show that's still rising. I spoke to Yellow Brick Road chairman Mark Bouris earlier today. Mark Bouris, thank you very much for your time.
You're welcome.
Do you think we're in a housing bubble? Are prices crazy?
Do I think people in Sydney are paying some crazy prices? Absolutely. We're not experiencing the same valuation and purchase price disparity that in Melbourne, Brisbane, Perth, Darwin, Adelaide. We're not seeing it there. We're not seeing it outside of Sydney, within New South Wales either. And in Sydney, it's only in certain pockets. So anecdotally, we hear about it. I mean, I hear about it, but we are actually seeing it in some of our transactions. But what's generally is the case is this is not a debt-fueled price spike. So it's not being spiked by debt, which is what's happened in the past. So it's not lenders encouraging people to borrow more, to pay more. It just seems to be the purchasers are prepared to pay more, and I think that comes in a lack of supply.
But it also isn't that being fueled by debt, people feel more comfortable about paying higher prices if there is cheap debt available?
I think the cheap debt part does help. People feel comfortable about paying a higher price, but generally speaking, the loan-to-value ratios are quite low relative to what I've experienced in past booms. I mean, this is a relative game. So if you looked at the boom up to, say, 2007-8, it was, generally speaking, fueled by more debt as a percentage of the purchase price than it is today. So during that period, debts were 105%, 110%, 95%, 97%. There's very few lenders in the market today even lending over 90%. In fact, most, if it's not owner-occupied, are pushed back to the 80%. So there's a lot more responsible lending practices, and that's been imposed by the regulator, as well as the banks in terms of their capital requirements. But there is still an exuberance in Sydney amongst many buyers to pay a higher price than everybody else. So there's this competitive element. I must have that property, and I'm going to beat everyone in the room. But they're spending it out of their own equity.
The Prime Minister ruled out any changes to negative gearing or the special capital gains treatment for investors. Is that the wrong call, do you think?
I don't think it's the wrong call, but I think the call should be let's examine it, because there may be some parts of the negative gearing and capital gains regime which, to be frank with you, they don't work unless they're together. They've got to be together. There are some parts of that you could use to perhaps stimulate certain parts of the new property market, as opposed to keeping the current stock of house prices high or investment properties high. What you want is there to be demand for new properties that stimulates construction and infrastructure and all the other stuff. Right now, the capital gains treatment, special capital gains treatment, and negative gearing for the difference between rent and interest, all it seems to do is stimulate across the board. Now, I don't know if you need to stimulate across the board prices. You need to stimulate activity in the new stuff. We want new construction.
Would it create a collapse in prices? Would it depress prices if that happened, which is what the government has been warning?
If you adopt the Labor Party regime, which Shorten's trying to promote, I think it could, because you at least must grandfather those people who've already bought into that environment. You can't say to somebody, oh, you bought 5 years ago, you bought it because you wanted the negative gearing and you wanted the capital gains treatment. By the way, we're going to let you have those deductions for the last 5 years, but from now on we're not going to let you have it, because all of a sudden they change the dynamic for that particular individual. That means they've got to go and earn more money, which is probably impossible, in order to pay their mortgage, which could be a disaster, because all of a sudden those people would start to put supply onto the market, and that will create a dysfunction, like a fiscal dysfunction, and all of a sudden people start to panic, and that's when you see prices dropping, land values change. That actually is a threat to the financial system.
You're going into the financial advice space. Is it an uphill battle for financial planners, do you think, in Australia now? I
think so, yeah. I think there's an uphill battle reputationally to show that they actually have the expertise to actually take you to where you want to go to when you turn 65 or 70, or whatever it is they're trying to, whatever the objective is. And to be frank with you, there are a lot of good quality financial planners too, but generally speaking, the that small percentage of people out there robbing people and stealing money and just giving crap advice, or reckless, or have no qualifications, or putting them into some scheme, there's backhanders, etc. You know, that is not the majority of financial planners in this country.
Mark Bouris, thank you very much for your time.
You're most welcome. Thank you.